Hello, this is Jamie Upson of Stonehearth Capital Management with our September 2014 Educational Economic Update. In this month's video, we'll be discussing a couple of the economic events that occurred last month and provide some insight into what they mean for you as an investor. Please stay tuned at the end for a required disclosure statement. September was a solid month for the U.S. economy. The labor market continued to improve, and the latest second quarter GDP estimate showed that the economy grew by 4.6%. Most importantly, the growth was shared across multiple sectors, which is a positive sign for the rest of 2014. Now let's talk about the Federal Reserve. With the economy improving, analysts are paying close attention to the Federal Reserve. The Fed held an open market committee meeting in mid-September. The Fed voted to maintain the pace of its tapering by dropping its monthly bond purchases to $15 billion a month. By voting to continue tapering, the Fed boosted confidence that the U.S. economy is doing well enough to take off the training wheels. The next move is interest rates, and the question on everyone's mind is, how long until the Fed raises rates? Some officials want the Fed to raise rates as early as the spring of 2015, which is earlier than most analysts had predicted. On the other hand, several other officials believe that the Fed should be extremely cautious and raise rates only when the Fed is certain that the economy has achieved enough momentum. These folks seem to favor leaving rates low until early 2016. Such disagreements are just a sign that there are so many ways to interpret the economic data. I want to just remind you why interest rate changes are so important to investors. The Fed has held interest rates at rock bottom levels in order to encourage lending to boost the economy. Now that the economy is improving, the Fed will need to slowly raise rates to avoid high levels of inflation, which negatively affect the economy by chipping away at buying power. If the Fed raises rates too soon, the economic recovery could falter. If rates are left low too long, inflation could spike, causing the economy to overheat. It's truly a balancing act. Rising interest rates can be a real thorn in the side of bondholders. Let's review an example to show you why. If I put $100,000 into a corporate bond today that is yielding 3% over the next 10 years, what happens to the value of this bond if rates rise and the new going rate for a corporate bond is now 4%? Unfortunately, my 3% bond is going to be worth less. Maybe it is now worth $95,000 or maybe even $90,000. Sure, you can hold it to maturity another 9 years away and get your $100,000 investment back, but chances are inflation is going to also be rising, meaning that your 3% interest rate is probably not going to keep pace with inflation. This results in a loss of purchasing power. This is an area that our investment committee has spent a considerable amount of time on to address this very concern. There are types of bonds out there that tend to perform better in a rising interest rate environment, which is where we have allocated a portion of our current bond exposure. The bottom line, we know higher interest rates are coming. We just don't know when. The good news is that the economy is improving and the signs favor continued growth this year. Looking ahead, investors will be turning their attention to the release of third quarter economic and corporate earnings data to see how the quarter stacked up. We're also approaching midterm elections, which can often exert some pressure on the markets as investors weigh how certain results may affect government policies. This concludes our educational economic update. Once again, this is Jamie Upson from Stonehearth Capital Management. If you have any questions about what you've heard in this update or would like to discuss your personal situation, please give us a call at 978-624-3000. We'd be happy to help you. While we believe this information is correct, while we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. The economic forecast set forth in the presentation may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Please consult your financial professional before making any investment decisions. Thank you.